Hi, welcome back. I've been feeling off balance for much of this year, and I'm sure I'm not alone because the world as we know it seems to be changing under us. And when I'm off balance, I find myself being reactive, reacting to events on the ground, and that's not good for me as an investor. So, two things I find myself doing whenever I'm off balance that help me. One is to step back and gain perspective, look at the big picture. The other is to go back to basics. And I'm going to try to do both in this session where I talk about Trump and tariffs and Tesla, a mix that is undoubtedly going to get me into trouble. Now, I'm going to start out with a couple of confessions. The first is I see the world in shades of gray. And in a world where more and more people see black and white and absolutes, that might make me not just an exception, but not that popular. In fact, if you've come to this session expecting either a diatribe or a tribute to Trump and tariffs, you're in the wrong place. I'm probably going to piss off both sides of the divide with what I have to say. The second thing I want to confess to is much of the work I do is in the micro setting. I value companies, I look at how they make corporate financial decisions, and the work I do in the macro world is primarily to help me in the micro endeavors that I have. So it's true, I estimate equity risk premiums for the S&P 500 at the start of every month, but I do it not because I want to pass judgment on the market, but because I need it to value companies. Now, earlier I talked about being reactive, and I think that I also am not that comfortable talking about politics, but in the world we're in, I don't think you can avoid it because politics and investing have kind of twinned together, and you can't talk about one without talking about the other. Now, as I go through the session, I'm going to try not to let my political thoughts kind of pervade my decisions because I think there is a tendency then to make bad decisions. With that lead in though, I want to talk about two major forces that I think have brought us to where we are today. The first is globalization. Now, it started taking off, at least in its current version, in the 1980s. And I'm going to talk about, how it crested in 2008 and why I think the backlash to globalization explains a lot of the politics and the economics of where we are now. The other is disruption, a word that took off from Silicon Valley 25 years ago, has changed businesses around the world, but it's now entered government and politics. So let's start with globalization. Now, globalization has always been with us, but in its current form, I think you can trace it back to the 1980s. I'm no historian, and there are people who are better suited to talk about globalization than I am. But I'm going to talk about globalization from the perspective of what I've seen happen in my classroom, the changes it has wrought. I also want to talk about winners and losers, and this is a subjective list, and I'm sure you will disagree with me, and how 2008, I think, changed the conversation on globalization. So let's start with the globalization and the personal history of globalization. I taught my first class in 1984, and it was a very dollar-centric world that I taught in. Much of the data that I used came from the US. Almost all of the cases and books in classrooms came from the US. My students were primarily going into domestic companies, go to work for companies that were domestic in their focus. So if they went to work for US companies, much of the production happened in the US and they sold their stuff in the US. If they went to work for a Chinese company or an Indian company, it did almost all of its production in India and sold to Indian consumers. There were multinationals, don't get me wrong, but those multinationals were more the exception than the rule. Have things changed? Absolutely. Today, when I look at my classroom, I have more foreign students than US students, and many of them go to work for companies which have their supply chain stretching across the world and their markets spread out across the world. My classes have globalized and my material is also more global. Now, having said that, clearly globalization has created some winners and losers along the way. In my view, the biggest winner from globalization has been China. One way to trace the rise of China and how much it has benefited from globalization is to look at its share of GDP over time. So you look at the table below, I look at the share of GDP from different parts of the world in 1980 and every 5 years since until my most recent snapshot in 2023. So if you look at the biggest gainer over that period, China has gone from 1.67% of GDP, a tiny slice of GDP, to 16.76%. It's increased its share tenfold. Now we look at the losers in a few minutes, but China has been clearly one of the biggest winners. Another way to see how much China has gained is to look at the percentage of the change in GDP in each decade that has come from different parts of the world. Let's take a look at this century. In 2000 and 2010, about 21% of the growth in global GDP came from China. Between 2000 and 2023, about 38% has come from China. Now you're saying, well, the US got an even larger percentage. You're right. But remember, the US was a larger piece of the global economy. And we'll talk about what's allowed the US to kind of hold its own during the period. It's the disruption part that I want to talk about that might explain that difference. But China has clearly been one of the biggest winners. Who are the other winners? Well, as I said, it's a subjective list. I think consumers have benefited from globalization, from having more choice and lower prices. You walk into a grocery store, you can buy food from around the world. That's a big change from where we were 40, 50 years ago. When you buy apparel, you're buying it at much lower prices than you paid otherwise because it's made in other parts of the world. Furniture, you can go down the list. Choice and prices, consumers have clearly gained. I think consumers have already also lost, and we'll talk about what they've lost. Global institutions have benefited. The World Bank and the IMF have been with us for decades, but their power has been amped up with globalization. And we've created new institutions along the way, new treatments, new agreements. Now, in North America, we had NAFTA in the 1990s. Europe created the EU, and these global institutions have gained power from globalization. Financial markets have become more central to our lives. More companies are listed in markets, and what happens in markets seems to drive policy. In fact, many governments with tax and economic policy check out what market reaction is before they adopt them. And the cities where these financial markets have been centered, Tokyo, New York, London, Frankfurt, have gained at the expense of the rest of the world. Gained in terms of wealth, maybe not in livability, in terms of wealth and power. And finally, experts have gained from globalization. We've always listened to experts, but globalization has given them new forums to present what they see as the problems of the world and their solutions. Forums like Davos and Aspen, where experts get up and tell policymakers what to do, and policymakers often adopt their suggestions. There have been winners. Have there been losers? Yes. Let's start geographically with what I see as the two biggest losers, Japan and Europe. And you can see what they've lost by looking at the share of global GDP that they commanded in 1995. Japan had 18%, Europe was 24%. And look at their shares in 2023. Japan in particular has fallen off the cliff from 18 to 4%. Europe has dropped from 24 to 15%. Notice again, the US has held its own, and part of it is it might have benefited from globalization, but I think the other force, disruption, can explain why it held its own. Now, who are the other losers? Let's start with a couple. One is, we talked earlier about how consumers gained in terms of choice and price, but they've also lost in terms of control. Now, when you buy a product, you're not quite sure where it's made. When you don't like it, you're not sure what to put pressure on. So we've lost some control in where we get our products from, and that makes consumers uncomfortable. The second is small businesses. Small businesses that had nice domestic markets found themselves competing against foreign companies that had, much cheaper production. You're saying, why weren't all businesses affected? Because larger businesses had more adaptability. They could move their production elsewhere. Earlier in one of my updates for this year, I talked about the decline of the small firm effect, where small firms that used to make higher returns than larger companies and markets. That small firm effect has disappeared over the last 4 decades. Lots of reasons, but one of them might have been the growth of globalization. The fourth loser that I can think of from globalization were blue-collar workers, factory workers in developed markets. In the graph that you see below, you see the number of manufacturing workers in the US from 1939 to 2024, with a percentage change each year. The number of manufacturing workers in the US peaked in 1979, about 20 million. And over the past few decades, you can see the loss in jobs from 20 million down to 13 million. We kind of plateaued off at 13 million, but clearly we've lost jobs to globalization. We can talk about where they've moved, but blue-collar workers in developed markets in particular have seen the loss. And finally, and this may be controversial, I think the cause of democracy has been hurt by globalization. We start by making the case that democracy over the last 2 decades in particular has slipped up. Now, The Economist has a measure where they look at the percentage of the number of countries and the percent of countries which are full democracies, flawed democracies, hybrid regimes, which are kind of democracies and a mix of authoritarian regimes and purely authoritarian regimes. In 2024, 60 countries, according to The Economist, were in authoritarian regimes, 39% of the global population. More than half of the global population, at least according to The Economist, lives under non-democracies. No. Now, the trend lines are not that good either. If you look at what the Economist measure of what's happened to democracy between 2006 and 2024, you can see the decline in democracy over that time. You're saying, what's globalization got to do with it? One of the biggest selling points for a democracy is that people get to choose governments that do their bidding. That if a government does not act in their interests, at least in theory, people can throw them out and replace them with a new government. With globalization, there is at least this perception that you can elect a new government, but the policies get adopted somewhere outside. It might be a perception, it might be flawed, but that perception, I think, has driven down the desirability of democracy. So there have been losers, and I think one of the mistakes that the advocates for globalization have made was while they were selling the world on its benefits, they didn't want to talk about the losers. In fact, they treated the losers often with disdain, calling them nativist or ignorant when they brought up issues with what globalization was doing to them. So in a sense, we reap what we sow. Now, globalization, at least in my view, peaked in 2008. And 2008 was a trigger to people reevaluating the benefits of globalization. Why? Because in 2008, I think we started questioning whether experts really knew what they were doing. It led to a loss of trust in institutions, in governments, in experts. And I don't think we're going to get that trust back soon. So if you look at much of what's happened since 2008, you see the backlash to globalization playing out. The initial reactions were incremental. In elections of new governments in the post-2008 era. But it kind of kicked into high gear over the last decade. The Brexit in the UK, where UK voters chose to leave the EU. The rise of the far right, as it's called in Europe, the election of Trump in 2016 and again in 2024. I think a big factor in those events was the backlash to globalization. Now, to those who who see this backlash as playing out as a return to old times, that's not going to happen. We're not putting this globalization genie back into the bottle. So even if we see a backlash, it's not like China is going to go back to being 1.67% of global GDP, that Europe and Japan are going to reclaim their positions that they had before globalization came along. Now, globalization, I think, has found itself into so much of what we do that it's not going to go away. But the world that emerges after this backlash is going to be a world with more frictions in globalization. And I think we have to be ready for that friction-filled world. Now, the other major force that has driven so much of what we see around us is disruption. Now, the best way to think about disruption is to look at the disruption playbook that the tech companies perfected over the last 25 years. It always starts with the business to disrupt. The business you want to disrupt should be a large business, lots of dollars spent. It should be inefficient at its core and have lots of dissatisfied players. So there are lots, if you look around, there are lots of businesses which have those characteristics, and disruption targets one of those businesses. It looks for the weakest links, because in these bad businesses, which are big and inefficient and unhappy, you often have products that make a lot of money, soft products that actually service less profitable products. But you have a lot of cross-subsidization. Disruptors go after those profitable products, which essentially subsidize the rest. The third thing that disruptors do is they move quickly, because they recognize that the status quo is often slow to move, and they scale up really fast with access to capital. So you move quickly and you scale up. Now, not all disruptors do it, but many disruptors in their playbook seem to break rules and ask for permission later, because they've discovered that by the time the regulators and the rule makers get around to acting, it's often too late. There is no alternative. So find a business to disrupt, target its weakest links, move quickly to scale up, break rules and ask for permission later. And then by the time people get around to recognizing that there are problems with the disruptors, there's no alternative, there's no place to go. You saw this play out with Amazon and the retail business. You saw it play out with the online advertisers with the advertising business, and ride sharing with the car service business. To name just a few. Now, of course, the question is, has disrupted created winners and losers? Obviously, the biggest winners from disruption have been the disruptors. And not so much in terms of money made, because disruptors often scale up before they make money. But it has, markets have rewarded them with huge market capitalizations, and it's made its founders incredibly wealthy people, investors and employees also wealthy. So disruptors have clearly been winners. The clearest, and consumers are secondary winners too, because in the process of scaling up, these disruptors have often provided their products and services at low prices and often below cost. The biggest losers from disruption is the status quo. No. As legacy companies scale down, there's a whole host of side losers, right? Their employees, the people who've invested in them, and the regulators who've often created the environment for the status quo. The peripheral damage to regulatory agencies or regulatory structures is because they're viewed as inept, because they've been unable to stop the disruptors. So winners and losers. And as I said, for much of the last 25 years, it's played out in business. Now, what's different about the last few years is disruption has come for bigger targets. Its record so far is kind of mixed. You take healthcare. Healthcare should be ripe for disruption, right? It's big, it's inefficient, and nobody's happy. Hospitals, doctors, patients, and disruption has not worked that well. I know that there are startups like Mark Cuban startup in the pharma business, or Amazon tried its healthcare startup, but they've not really taken off. Education. Big, inefficient, lots of unhappy players. Again, disruption has not worked that well. But disruption has come to government, and Latin America seems to be the starting point for this. Javier Milei and Nayib Bukele in El Salvador, Javier Milei in Argentina, both brought the disruption playbook to government. And they've probably been helped by the fact that both those countries the governments were viewed as so broken that the reaction of people was, hey, what can be worse? Now, as you watch Elon Musk and Doge play out in the US government, clearly they're bringing the disruption playbook to government. They're moving at hyper speed, breaking age-old systems, pushing laws and norms to breaking point and beyond. And the question is it going to work? I'll admit I have mixed feelings. On the one side, I do believe the US government is broken. The budget system is broken, and Congress seems incapable of fixing it. It plays with the edges. The legacy problems are too deep. So clearly, there is a need for disruption. That said, I'm not sure breaking everything at the same time, doing what you do at a company, works with the US government. Why? Because there are lots of people who are dependent on the US government, vulnerable people, people on Medicare and Social Security, that if you break those systems and you don't fix them really quickly, the damage could be catastrophic. So if Doge is going to work, it's got to find a way to fix these breaks quickly, because otherwise we're going to have lots of casualties on the field. So globalization and disruption are playing out as you look at politics and government today. Now, as I said, I'm interested in what's happening as an investor. And the macro effects of what's happening play out in two places. One is in interest rates. And if you look at US Treasury rates between November 2024 and March 2025, the effect has been relatively muted. So in this graph, you've got 20-year rates, 10-year rates, 5-year, 2-year, and 3-month T-bills. 3-month T-bills have pretty much flatlined. So that's a black line right down the middle. 10-year rates and 20-year rates have actually come down since the start of the year. The yield curve has become pretty flat. For those of you who use that as an indicator, it's a very flawed indicator. It's not clear what it's signaling. But Treasury rates basically have kind of stayed in place, or come down over the last few months. Now, if you're a Trump supporter, you're going to point to those rates coming down and point to it as good news that inflation is coming down. After all, rates reflect inflation and real growth. If you're a Trump opponent, of course, you're looking at the same drop in rates. Say, see, the recession is coming and the market sees it. But the Treasury rates reflect, I think, those two competing views about inflation and the real economy. The other thing I track, and this is on a monthly basis, is the implied equity risk premium. I take the level of the index and I back out of it what investors are demanding as an extra return over and above the Treasury rate. So think of this as your receptacle for your hopes and fears. That number leading at the time of the election was 4.29%, and for most of all the way through March, that number didn't budge by very much. It dropped between November and December. It went up again, but kind of March of 2025 was 4.35%, not that different from where you started right after the election. In the 2 weeks in March, clearly something has changed, because that equity risk premium has jumped from 4.35 to 4.68%. That's the highest number we've seen since the start of 2024. The fear factor is clearly winning out over the last 2 weeks, and that number will bear watching, because one way to think about what will happen over the rest of the year is to think about this equity risk premium and what it might continue to do. If it continues to climb, I think there's no way around it, but stocks have to go down. If it continues to, and that's true even if you don't have a recession, if it continues to climb and you have a recession, you've doubled the potential damage. So that number is worth watching as we go through the rest of the year. Interest rates and equity risk premiums. Now, as I said, though, my interest is more in company, at the company level. And here I thought, as I wrestle with how all of this play out on company valuations, I went back to the basic drivers of value that I've used before. Revenue growth, margins, and how efficiently you deliver growth, driving my cash flows, and risk driving both the cost of capital that I use to discount these cash flows and failure risk. So I looked at Trump's the tariffs and tariff wars and trade wars. Tariffs and trade wars, and what it might do to my valuation through those drivers. Let's focus on revenue growth. The companies that are going to be most hurt by trade wars and tariffs, obviously, are going to be companies that derive a greater percentage of their revenues from foreign markets. If you look across the sectors and you look at variations, the sector that gets the largest percentage of revenues from the rest of the world for US among the S&P 500 companies is technology. 59% of revenues come from outside the US. The sector that gets the least percentage of revenues outside, then this answer might be obvious, is utilities. But healthcare too is a low number, it's 14%. I think the sectors that have the greatest exposure from tariffs and trade wars are the sectors which have the most revenues, most from foreign sales. In terms of costs, those companies which have production or supply chains running through foreign locales are more exposed to trade wars than companies without. Stating the obvious again, but might as well state it. So something to look at. And this, I think the data is more difficult to get than on revenues. Capital intensive companies which are dependent on cheap labor, which have over the last 4 decades moved their factories or their production offshore, are going to be more exposed to trade wars than companies that are not capital intensive and not as reliant on cheap labor. From a risk perspective, I think tariffs and trade wars will put upward pressure on interest rates, partly because they will affect inflation, but that might be offset a little bit by the drag they might create on the economy. Overall, as you look at company valuations, you're going to see disparate effects. Not all companies are going to be hit the same way. And looking at where companies get their revenues, where their production is, might give you a starting point as to where you might want to invest as an investor to protect yourself against trade wars. The other way to think about what tariffs and trade wars and disruption will do is how they will play out in company stories. I've been long a proponent for the view that every valuation is a bridge between stories and numbers, and you've got to stop and make sure your story passes the 3P test. Is it possible, plausible, and probable? If you stay with that structure, the value of a company can clearly be affected by political connections and by the government acting as an ally or an adversary. I've written about this in the context of companies are valued. In 2019, when I talked about the big Chinese tech companies and the crackdown that the Chinese government put on them and how they showed up in value, I talked about how their value is being affected by the Chinese government going from being an ally to an adversary. Now, historically, when you valued US or European companies, you had the luxury of keeping the government out of your story other than in their role as tax collectors and regulators. Now, I think those days might be done. I think that that the government might be in play, a part of the story of many companies, even in the US and Europe. And you might have no choice but to talk about that effect in your value. Now, of course, the company where you're seeing this interplay between politics, government, and business the most, in the center of the storm, is Tesla. And I have a company I valued repeatedly over time, most recently in late January of 2024, when I valued about around $180. In fact, I bought Tesla when it hit 170 a few weeks later. But clearly the Tesla story has had a roller coaster ride during 2024. In markets, the stock price surged from 170 to over 400 just after the election. But a big portion of that surge had less to do with Tesla, the company, and more to do with the politics of the day. Investors seemed to be building into Tesla's market cap the expectation that Musk's forays into politics would pay off in terms of economics for Tesla. But the Tesla story has hit some roadblocks with or without the politics. And I can think of at least 3 ways the story has hit roadblocks. The first is this notion that we were on this pathway to electric cars, that electric cars were everybody was going to own an electric car in 10 or 15 years, which is a story that was being promulgated a couple of years ago. That story seems to have changed. Part of it, I think, is the acceptance that hybrids and gas cars are here to stay and that they're not going to go away, and that electric cars are not the unmixed blessing for the environment that we might have thought they were just a few years ago. So there's a rethinking of that story. There's a rise of a competitor. Until 2 years ago, it was Tesla or Tesla. You're saying legacy automakers seem to be in no position to challenge Tesla. But BYD has risen as a potential competitor. In fact, in 2024, BYD sold more electric cars than Tesla did. And the company is making forays into markets outside China and often going head-to-head against Tesla, offering better pricing. So you've got a rethinking of the electric car story. You got the rise of BYD, and there's no denying the fact that politics has entered the Tesla story. It's entered in very real terms, in terms of people choosing not to buy Tesla cars because they don't like Musk or Musk's politics. You're seeing the effects show up in Europe and even in the US. And as Musk remains the center of news stories, I think that backlash will continue to play out both in markets and in business. So I decided to revisit my Tesla valuation with these changes incorporated. And if you remember, I valued Tesla just a year ago at 180. And I do think that the changes, the entry of BYD as a competitor, the change in the electric car story, have clearly made the electric car market smaller for Tesla, the potential market. Because I think that in my end game, I think that you now are more likely to see it two companies dominating. One in the premium electric car market, where I think Tesla will still remain the big winner. But in the mass market auto business, especially with Asia as the big market for that, I think there's a very real chance that BYD could win that market. So my expectations of revenues for Tesla have come down a little bit. I've left the bulk of the rest of my story intact because I don't think that the margins I'm aspiring to and the other stories we were telling about Tesla, about automated driving or about software and energy, those stories are still there. The value that I got is about $150 per share, when I put in this new story. That's clearly below the 180 that I got a year ago, and it's still below the stock price of even after the hammering that Tesla's stock price has taken in the last few weeks. Stock price is 220, 225, so the stock looks overvalued now. I did liquidate much of my Tesla position right after the election, partly because not because it's not a question of political perspective. I'm not comfortable investing in a company where politics becomes the key driver of the stock price. But if at the moment Tesla looks overvalued to me from a pure business perspective with all of the ingredients built in. But that could very quickly change with in terms of if the price continues to decline. So for the moment, this is where I stand. And as I said, I've tried to keep my politics out of the analysis, but that's going to be, doing it completely is always going to be impossible. So what's the bottom line? Now we can blame the market uncertainty on Trump and tariffs and trade wars, but I think that the forces that have led us here have been building for years and they're not going away. So even if Trump withdraws his talk of tariffs and the trade wars don't manifest, the forces of anti-globalization have been unleashed and they're going to continue to play out in markets, in politics, and in global commerce. For investors, I think that'll require, that might mean there's a shift away from the big winners of the last couple of decades, big technology companies, towards smaller companies, perhaps to other sectors. Now, I'm not quite ready to make a sector bet, but I think that we are going to see a reversal of some of the things that we've seen for the last 20 years. Winners becoming losers and losers becoming winners. And we have to be ready for that. I hope you found this session useful. And if you disagree with what I have to say, that's perfectly okay. I think you can live with that disagreement. And I thank you very much for listening.